Good morning, everybody. This is Chris Robinson, Robinson Ag Marketing, with today's pre-opening grain and livestock comments for Tuesday, the third day of February. I want to lead off with crude oil. I had this in my letter, the weekly, and also in the daily a few times. The Iranian bombing high back in May, June, July, when we hit $78, that slid us into just below $55 at Christmas time, which was a 5-year low. That 5-year low didn't get much attention in the television. But boy, rally from 55 to 66 and it's all over, right? Why is 66 significant? If you follow my letter, if you knew my letter, you know that I'm a big follower of retracements, and the most simple retracements are the ones that I follow. I do not complicate stuff. So many people can make technical so complicated that at the end of the day, you're looking at a page that has 16,000 lines on it, and 18 intersections, and this area might. I try and keep it very simple. So there's nothing more simple, in my opinion, than these Fibonacci's. Now the rub is, it's always depends on which high and which low are you using when you run your retracements, right? So there's certainly not a science. There is some judgment involved with it, but I'll just say this. Uh, that move takes 78 to 55. 66 is halfway back. We didn't nail it exactly. That's another thing. People that are not fans of technical analysis will say, well, it's not always right. Well, it's pretty darn close. There's that expression, horseshoes and hand grenades. Certainly, I would have said this, and I tried to tell people, read my letter, that when you get up to those halfway back retracements, it's a judgment call. So bull or bear, you've got a decision to make. Now, I'm not saying it couldn't have gone higher, but it's always a good area to take a look at your risk. And we may get back there again. We've pulled back. We broke from 65 to under 62. Let's see, the high of the move was 66.11, and last night's low was 61. So, perfect example. Somebody gets all excited because they see a story about crude oil spiking on television. They buy crude oil and they lose $5. So just be careful when you're making emotional decisions when it comes to these markets. And that would apply to everything. I don't care if you're trying, looking at crude oil or the stock market, or if you're a farmer or rancher who, 90% of my clients are farmers and ranchers who need help managing the risk. You've got all this risk in the cash market. How can you use some hedges to lay off some of that risk onto the speculators they're willing to take your risk. So let them have it. When prices hit your level that you like, if you can't sell it, then you need to hedge it. It's really that simple. People make it a lot more complicated than it is. Now the rub is, people hate to make decisions because they're always worried that they're going to be wrong. And that's kind of the beauty of a hedge. If you hedge it right, you can still have capture a chunk of revenue, but you're not necessarily exposing yourself to margin calls once you've set your hedge. And that works best if you use a long option strategy. And that's what I try to do here, Robinson Ag Marketing. Okay, March corn overnight, a 3-cent range, up 1 3/4 cent. The beans, a 10-cent range, up 8 1/4 cent, 10.68. March beans, 3 days ago, we're trading at 10.85. They traded down to 60, the 25-cent move. Enough. I don't know. I would get used to seeing multiple 25-cent moves in beans this year. I think if you're looking for the most active, volatile grain market, it's going to be soybeans. Corn is a grinding market with a narrow range, and wheat is, for lack of a better word, schizophrenic. Some days it's up, some days it's down. It's the hardest of all three to keep a track on. Wheat is range bound. You can go back all the way to July of last year when we petered out at 552, and then we have a bottom level down around $5 to 4.90. So we're in the 50-cent sideways trading range in wheat, and we just have to wait for that breakout. And I'll be honest with you, I don't make a living promising people that we're going to go to $7 wheat or that we're going to go to $2 wheat. What I try and do is say, hey, we can defend this level. Let's look at how much that costs. How can we do it the cheapest to defend that level so you don't lose revenue suddenly? And then the other strategy is just absolutely positively keep your upside open so that when levels do get healthy again, And again, it's only February. We got a lot of 2026 ahead of us. If we get some healthy levels, we want to be able to reward it with some cash sales. It's really that simple. So we try and manage your net long position, looking for opportunities to make good cash sales, while also holding on to the grain as long as we want to. If you want to hold on to grain, that's great, but you need to have a hedge under it while you're holding on to it, because you don't want to be in a situation where you go to bed one night. We just had it, right? We had soybeans rallied to 8-month highs, and that little spike in November, and then 6 weeks later we dropped $1.30. If you did nothing to reward that rally, you left a lot of potential revenue on the table. So in that event, if you're looking for help, you may call 312-638-8868. This is Chris Robinson, Robinson Ag Marketing. We'll see what happens today in the cattle market. It was a bullish inventory report, and it just looks like April fat cattle and the March feeders, they really have got a whiff of those upside, those old gaps going back to the contract highs. So that's probably what we're going to be dealing with here through the rest of this month. Can we get up there? Can we get new highs? Now, the people that everybody loves to hate, the managed funds, they're all bet long the protein complex with you. So right now, they are the wind at your back. Take advantage of them. All right, guys, have a great day. This is Chris. Take care.